You need to hear something that no government office, no financial advisor charging fees, and no automated letter from any federal agency is ever going to tell you. Right now, buried inside the Social Security Administration's processing system, there is an instruction with your name attached to it that is pulling money out of your check every single month based on a financial life you no longer live. That instruction was created by you years ago on a one-page form you probably do not remember completing. You selected a box, you mailed it in, and from that moment forward, the federal government began deducting a percentage from every Social Security payment you receive, month after month, year after year, with no expiration date, no automatic review, and no mechanism to alert you when the amount being taken no longer has any relationship to what you actually owe. For millions of American retirees, that outdated instruction is costing $200, $300, or more than $400 every single month in unnecessary withholding that flows into a government account, earns zero interest, and returns once a year as a refund they mistake for a bonus when it was their own money the entire time. This is not a new tax. This is not a rule change. This is not something Congress did last session. This is a checkbox problem on a form called the W-4V, and the correction that stops the bleeding permanently takes less time than a trip to the pharmacy. The W-4V is the federal form that instructs the Social Security Administration how much income tax to withhold from your monthly benefit. It offers 4 flat rate options and nothing else: 7%, 10%, 12%, or 22% of your gross benefit amount. No custom numbers, no graduated scale, no annual recalculation, no trigger that adjusts your rate when your income changes, when your spouse passes away, when your pension stops, or when you qualify for deductions that did not exist when you originally filled it out. You picked one of those 4 percentages during the early days of your retirement, probably at a moment when you were still adjusting to the transition, possibly while part-time income still flowed in, possibly while your tax bracket looked nothing like it does today. And that single selection became a permanent standing order. The Social Security Administration took it, filed it, and has been executing it with mechanical precision on every payment since, never once pausing to ask whether the instruction still serves your interest. During your working years, your employer's payroll system recalculated withholding when circumstances changed. The Social Security Administration performs no such function. It is not a payroll department. It is a payment processor running your original command on an infinite loop until the day you physically replace it with a new one. 2 groups of retirees are caught in this trap, and both are convinced they are not affected. The first group sees a withholding deduction on their monthly Social Security statement and assumes the amount must be appropriate because a government agency is handling it. This is the most expensive assumption in retirement. The Social Security Administration did not calculate your withholding based on your tax return, your current income, or your actual liability. You chose a percentage years ago, and that choice has been applied without variation to every check since. If you selected 10% in 2009 while still working 20 hours a week, you are withholding 10% today, even if that job ended a decade ago. Even if your only income now is Social Security itself, even if the IRS formula that determines taxability of Social Security shows that you owe nothing. The agency will not tell you this. It will continue withdrawing your money until you tell it to stop. The second group selected zero withholding and believes they are keeping their complete benefit. The check arrives monthly with no deductions, which feels like the full amount. But zero withholding does not guarantee zero tax liability. If income from pensions, traditional IRA distributions, investment dividends, or other sources combines with Social Security to push provisional income above specific IRS thresholds, tax is owed on up to 85% of your benefit. These retirees are not keeping everything. They are building a debt to the IRS that appears every April, often carrying underpayment penalties and interest that add insult to an already unpleasant surprise. The reason neither problem gets flagged is architectural. The Social Security Administration and the Internal Revenue Service are completely separate federal entities. They maintain separate databases. They follow separate mandates. They share no automatic communication channel that would compare what is being withheld from your Social Security against what you owe at year-end. The Social Security Administration delivers benefits and processes withholding elections. The IRS collects returns and calculates liability. Neither has a duty to inform you when those two numbers diverge. Neither will send a courtesy notice suggesting you file a new W-4V. The disconnect persists indefinitely, costing you money every month. It remains uncorrected, while both agencies fulfill their narrow functions perfectly, and your financial well-being falls through the gap between them. The dollar impact of this disconnect accumulates with brutal efficiency. A retiree collecting $2,200 per month who selected 10% withholding sends $220 to the federal government every single month. That is $2,640 per year in prepaid taxes. If the actual annual tax owed on Social Security income is $800, the annual overpayment is $1,840. Across 5 years, that totals $9,200 held unnecessarily by the government. Across 10 years, $18,400. Across 15 years of unchanged withholding, $27,600 transferred from a retiree's account to a federal holding account where it earned nothing, did nothing, and waited 12 months at a time before being returned in annual installments called refunds. The retiree treated each refund as a pleasant surprise. In reality, it was a delayed return of their own earnings that should never have left their account at the rate it left. Understanding whether your withholding should be adjusted or eliminated requires understanding the provisional income formula, which is the IRS mechanism that determines if any of your Social Security is federally taxable at all. The common belief that Social Security benefits are automatically subject to income tax is wrong. Taxability is not guaranteed. It is conditional, determined by a specific arithmetic formula applied to your total income picture. The formula instructs you to take your adjusted gross income from every source except Social Security, add any tax-exempt interest income you received during the year, then add exactly 50% of your total annual Social Security benefit. The resulting sum is your provisional income. For single filers, if that number is below $25,000, none of your Social Security benefit is taxable at the federal level. Between $25,000 and $34,000, up to 50% may be taxable. Above $34,000, up to 85% may be taxable. For married couples filing jointly, the zero tax threshold is $32,000, and the 85% tier begins above $44,000. The senior bonus deduction, $6,000 for single filers and $12,000 for married couples, does not reduce provisional income because the formula is calculated before deductions are applied. It does, however, reduce taxable income afterward, which can lower or eliminate the actual tax owed on whatever portion of benefits the formula identifies as taxable. For retirees living primarily on Social Security with limited other income, running this formula with real figures often produces a provisional income below the zero tax threshold. If your number falls below $25,000 as a single filer, or below $32,000 as a married couple, you owe no federal tax on your Social Security, and every dollar being withheld is being withheld for no reason. Your correct W-4V selection is 0. For retirees with pensions, traditional IRA withdrawals, and investment income, provisional income likely exceeds the lower threshold and some portion of benefits is taxable. However, the actual tax generated after applying the standard deduction and senior bonus deduction may be significantly less than what 10 or 12% flat withholding has been collecting. A married couple reporting $28,000 in pension income, $8,000 in IRA withdrawals, and $30,000 in annual Social Security calculates a provisional income of $51,000, entering the 85% tier. But after deductions, the effective tax rate on Social Security income may fall well below their current withholding rate, meaning they continue overpaying month after month by a substantial margin they never calculate because no one prompts them to. The correction requires one concrete action: retrieve last year's tax return, identify adjusted gross income and subtract Social Security, add tax-exempt interest from line 2A of Form 1040, add 50% of total Social Security benefits from Box 5 of the SSA-1099. Compare the result to thresholds. If below, submit a new W-4V selecting 0 withholding. If above, calculate the real tax on the taxable portion and compare to what is currently withheld annually. The difference is money being lost every year. Download the W-4V from the IRS website. Complete lines 1 through 4. Select the appropriate rate or 0 on line 6. Sign it. Mail it to your local Social Security Administration office. Do not mail it to the IRS. Processing takes 30 to 60 days. The updated amount appears in your check within 1 to 2 cycles after processing. 1 page, 1 envelope. The unnecessary drain ends. A necessary caution accompanies this information. Reducing withholding below your actual liability without alternative coverage through estimated quarterly payments creates a bill in April. The purpose of this correction is precision, not avoidance. If you owe tax, match your withholding exactly to that obligation. If you owe nothing, stop all withholding and keep your money. The error being corrected is not the existence of withholding, but the staleness of it, the fact that a rate chosen during one financial chapter continues operating during a completely different one without any human being ever revisiting whether it still serves a purpose. There is a second deduction embedded in Social Security checks that many retirees overlook entirely. Medicare Part B and Part D premiums are deducted directly from benefit payments each month. For retirees whose income exceeded certain levels during their working years, those premiums include an income-related monthly adjustment that adds a surcharge on top of the standard premium. This surcharge is calculated from income reported on the tax return from 2 years prior. A retiree who earned $70,000 at age 63 and retired at 64 has Medicare premiums at age 65 based on that $70,000 year. Even though current income may be half that or less, Medicare cannot see the drop because its data is 2 years old. The surcharge can range from $70 to $443 per month, added to the standard premium. The form that corrects this is the SSA 44. It requests a recalculation based on a qualifying life-changing event, and retirement is specifically listed as qualifying. Submitting the form with documentation of the income change, typically a retirement letter from the former employer, triggers a recalculation based on current income rather than the outdated figure. Processing takes 30 to 90 days. The corrected premium applies from the month of processing forward. Each month of delay is a month of overpayment that cannot be recovered afterward. Documentation must be complete at submission because rejected forms require resubmission and add months to the timeline. For retirees seeking not just to correct withholding, but to permanently reduce the tax liability on Social Security income itself, 2 strategies directly alter the provisional income formula. The first is Roth IRA conversion. Traditional IRA withdrawals are included fully in provisional income. Every dollar withdrawn from a traditional IRA raises the number that determines how much Social Security is taxed. Roth IRA withdrawals are excluded entirely from both adjusted gross income and provisional income. Converting traditional IRA funds to a Roth during low-income years, particularly the window between retirement and the start of Social Security or required minimum distributions, imposes a one-time tax at a low current rate and permanently removes those converted dollars from future provisional income calculations. Converting $150,000 over 3 years at a 12% rate costs approximately $18,000 in tax, but reduces future annual provisional income by the amount of yearly withdrawals from that converted balance. If withdrawals would have been $15,000 per year, provisional income drops $15,000. Annually going forward, potentially shifting Social Security from 85% taxable to 50%, or from 50% to 0. Recovery of conversion cost through Social Security tax savings alone typically occurs within 5 to 7 years, with every subsequent year representing pure financial gain. The second strategy is the qualified charitable distribution, available to retirees 70 and a half or older who donate to charity and hold traditional IRA funds. A regular charitable deduction reduces taxable income after provisional income is set, leaving the provisional income number untouched. A qualified charitable distribution removes the donated amount from gross income completely. It never appears on the return as income. It never enters provisional income. A $10,000 qualified charitable distribution reduces adjusted gross income by 10,000, drops provisional income by 10,000, and can shift the taxable percentage of Social Security from one tier to a lower one or from taxable to entirely non-taxable. For a retiree in the 85% tier with $2,000 monthly in Social Security, moving from 85% to 50% eliminates tax on $8,400 of benefits annually. At a 22% marginal rate, that equals $1,848 per year, saved from one distribution, independent of any other deduction benefit. The central principle uniting every strategy discussed is that the Social Security Administration, the IRS, and Medicare each operate within completely isolated systems. None communicates with another on your behalf. None monitors whether your withholding, your premiums, or your provisional income position has changed. None will ever initiate contact to suggest a correction that saves you money. The Social Security Administration executes your decades-old withholding instruction without question. The IRS processes your return without telling the Social Security Administration your withholding is excessive. Medicare charges premiums based on stale income data without checking whether retirement dropped your earnings years ago. Every one of these systems will continue costing you money until you intervene with updated information and corrected instructions. The W-4V, the Provisional Income Formula, the SSA 44, the Roth conversion, and the Qualified Charitable Distribution are not hidden strategies. They are published, available, and free to use. The only barrier was never knowing they needed to be used, and that barrier no longer stands for you. Act on this knowledge before another month of unnecessary deduction leaves your account. Forward this to one person over 65 collecting Social Security. A parent, a neighbor, a sibling, a friend. Every retiree who filed a W-4V years ago and never replaced it is almost certainly withholding the wrong amount. A single conversation could restore $200 to more than $400 to their monthly deposit, starting with the very next payment. That money is theirs. It always was. It has been parked in a government account earning nothing because no one ever told them the checkbox they selected was not a permanent decision. Social Secure USA now.